What if the next 15 minutes could change your financial future forever? Imagine waking up 5, 10, or even 20 years from now. Your investments have grown, shielded your wealth, and set you up for financial freedom. And it all started with the decisions you made today. Here's what most people get wrong: they guess, chase trends, and wait for the perfect time, which never comes, but not today. Because in this video, I'll give you the exact roadmap to invest boldly in your 20s, build a $50,000 portfolio in your 30s, shift towards income and stability in your 50s, and secure a $50,000 retirement portfolio that generates passive income. Welcome to Investment Guidance. I'm Rudy Banerjee, and in just 15 minutes, I'll break it all down step by step. And as a bonus, stay until the end, subscribe, and drop your email. I'll send you a detailed $50,000 portfolio plan for your 30s and 60s straight to your inbox. This might be the most valuable 15 minutes of your life. So let's dive in. Here's the truth: predicting the market is a gamble, but patience, discipline, and diversification, that's where success happens. Harry Markowitz, the father of modern portfolio theory, said it best. Successful investing isn't about timing, it's about balance. By combining stocks for growth, bonds for stability, gold for protection, and even crypto for innovation, you're building a portfolio that evolves with your goals and shields your wealth. Let's build it together. Let's simplify this. Imagine building a balanced meal. You wouldn't fill your plate with just one thing, right? You'd add protein for strength, veggies for health, and carbs for energy. Portfolio allocation works the same way. It's about dividing your investments across stocks for growth, bonds for stability, and other assets like gold or crypto to balance risk and reward. For example, a 20-year-old might load up on 70% stocks, which is the protein of your portfolio, for explosive growth. A 60-year-old nearing retirement might shift to 30% stocks and 50% bonds, which are the veggies, hence, focusing on stability. The goal: a portfolio tailored to your age, financial goals, and risk tolerance. When done right, it's like crafting the perfect meal: nutritious, balanced, and designed to help you thrive. Thinking of investing is like planning a road trip. Would you hit the road without a map, a spare tire, or fuel? Absolutely not. Here's what you need to check off first. Number one, emergency fund. Save 3 to 6 months of living expenses for unexpected bumps. Number two, debt. Pay off high interest debt. It's a guaranteed return. Number three, budget. Know how much you can invest without straining your lifestyle. Number four, goals. Are you saving for retirement, a dream home, or your child's education? And number five, platform. Choose the right brokerage for your style, whether hands on or automated. And here's a tip: prep your financial car before hitting the investment highway, and your journey will be smooth and exciting. Let me ask you this: would you drive a race car on a mountain road without brakes? Of course not. That's exactly what happens if you don't adjust your portfolio as you age. When you're young, you have time to recover from risks, so your focus is on growth. As you age, protecting what you've built and generating income becomes the priority. Here's how it changes. In your 20s, think of yourself as climbing a mountain. You're taking risks, adjusting your path, and aiming for the summit. Your portfolio should reflect this, with 70 to 75% in stocks for growth. In your 50s, you're closer to the peak. Every step becomes cautious, focusing on 50% stocks and 35% bonds to balance growth and stability. In retirement, which is 65 plus. It's time to descend slowly and safely. Here, 25% stocks and 35% bonds focus on stability while generating income with 30% cash or real estate for liquidity. And here's the bottom line: age is your compass. Younger investors can afford to take risks, but as you age, the priority shifts to preservation and income. Not comfortable picking individual stocks? Don't worry. Index funds and ETFs are the building blocks of your portfolio. Here's why they are so powerful. Number one, VFIAX and SWPPX. These give you a slice of corporate America, owning giants like Apple, Microsoft, and Amazon, tracking the S&P 500 for steady growth. Number 2, VTSAX, own the entire US economy from Fortune 500 companies to small cap innovators. And number 3, VBTLX, diversify across US bonds for stability and consistent income. These funds are low cost, diversified, and reliable. Think of them as the foundation of your financial skyscraper: solid, long lasting, and built to stand the test of time. Your 20s are your golden decade. Time is on your side, compounding is your superpower, and this is your chance to take calculated risks for explosive growth. Here's the recommended allocation. Number one, 70 to 75% stocks. This is where you drive the most growth. Focus on high growth sectors like AI and tech with NVIDIA, symbol NVDA, Microsoft, symbol MSFT, and Alphabet, symbol GOOG. Add exposure to emerging markets with Vanguard FTSE Emerging Markets ETF, symbol VWO. Number two, 10 to 15% bonds. Stabilize your portfolio with Vanguard Total Bond Market ETF, symbol BND, or iShares Core US Aggregate Bond ETF, symbol AGG. Number 3, allocating 5% of your portfolio to crypto in your 20s can be a strategic move due to high growth potential, early adoption advantages, and long investment horizons. Coins like Bitcoin and Ethereum have historically outperformed traditional assets over the long term. Bitcoin's ROI since 2013 is over 50,000%, while Ethereum's ROI since 2015 has been over 30,000%. Number 4, 5% allocation to gold. Hedge inflation with the Sprott Physical Gold Trust, symbol PHYS. When inflation rises, your money loses value. For example, if inflation is 5% per year, something that costs $100 today will cost $105 next year. Over time, cash sitting in a savings account loses its purchasing power. Gold, however, maintains its value over time and has historically risen during inflationary periods. And number 6, 5% cash. Maintain liquidity for emergencies or market dips. And here's a quick tip. Revisit your portfolio yearly. If stocks or crypto outperform, shift gains into bonds or gold to stay balanced. All right. So in your 20s, the goal is max growth, taking bold risks, capitalizing on high growth sectors, and letting time do the heavy lifting through compounding. But as you enter your 30s, the game starts to change. You're likely to earn more, maybe settling into a career, thinking about major life goals, a home, family, or financial security. This means it's time to adjust your portfolio, still focused on growth, but with a greater emphasis on balance, stability, and protecting what you've built. So, how do you structure a $50,000 portfolio in your 30s to maximize growth while reducing risk? Let's break it down. Number one, $27,500 or 55% into stocks. For growth, NVIDIA, symbol NVDA, Microsoft, symbol MSFT, and Apple, symbol AAPL. When structuring a balanced growth in your 30s, dividend paying stocks provide stability, passive income, and long term growth potential. Coca Cola, symbol KO, and Johnson and Johnson, symbol J&J, are solid standouts as top picks in this stage. If you need a fund option, the Vanguard Dividend Growth Fund, symbol VGIGX, can be purchased for diversified growth. Number two, $12,500 or 25% in bonds. Why? Because as you get older, stability matters more. Here, Vanguard Total Bond Market ETF and symbol BND or the iShares Core US Aggregate Bond ETF symbol AGG can be used. Number three, $2,500 or 5% into crypto. You can use Bitcoin or ETF or Ethereum. And as an ETF option, you can utilize the iShares Bitcoin ETF symbol IBIT. Number four, $2,500 or 5% into gold. And you can hedge with the Sprott Physical Gold Trust PHYS. Number five, $5,000 or 10% in cash, where you can maintain liquidity for emergencies or opportunities. And here's a quick tip: revisit your portfolio yearly to keep it balanced and aligned with your goals. All right, now let's move on to your 50s portfolio because here is where strategy really starts to shift. By your 50s and 60s, it's time to solidify your financial fortress. Focus on steady growth and reliable income while reducing risk. Here's a recommended in allocation. Number one, 45 to 50% stocks. Dividend paying stocks like Procter and Gamble, Coca-Cola and Johnson and Johnson. Here's a fund option. Vanguard Dividend Growth Fund, symbol VDIGX, for reliable income producing stocks. Number two, 30 to 35% bonds. Stabilize your portfolio with the Vanguard Total Bond Market ETF or iShares Core US Aggregate Bond ETF. Number three, 5% into crypto, a small allocation to Bitcoin or Ethereum. Number four, 5% in gold or silver. Hedge with inflation with the Sprott Physical Gold Trust, symbol PHYS, or Silver Trust, PSLV. Number five, 10 to 15% cash and real estate. Generate passive income with the Vanguard Real Estate ETF, symbol VNQ, or keep cash for emergencies. Here's a quick tip: adjust yearly to balance growth, stability, and income as you approach retirement. By the time you hit your 50s and early 60s, your investment strategy has already shifted to a stability and income. You've spent decades growing wealth, and now the focus is on protecting what you've built while generating passive income. But as you enter your 60s and beyond, the priority changes once again. Now, it's not just about stability, it's about security, liquidity, and ensuring your market money lasts for decades into retirement. This is where capital preservation, steady income generation, and smart withdrawals become the core of your financial strategy. So, how do you structure a $50,000 retirement portfolio to ensure financial security while still keeping your money working for you? Let's dive into the ultimate retirement portfolio, the blueprint for preserving wealth and generating a passive income in your 60s and beyond. Number one, 12,500 or 25% into stocks with dividend paying stocks like Coca-Cola, PepsiCo, and Procter and Gamble. And if you need an ETF option, you can use the Vanguard High Yield ETF, symbol VYM, for reliable income. Number two, $17,500 or 35% into bonds, where you can use the Vanguard Total Bond Market ETF, symbol BND, or iShares Core US Aggregate Bond ETF, symbol AGG. Number three, $2,500 or 5% into crypto. using Bitcoin or Ethereum or ETF, IBIT. Number four, $2,500 or 5% into gold. Here you need to protect against inflation with the Sprott Physical Gold Trust, symbol PHYS. And number five, $15,000 or 30% into cash or real estate. Keep cash in a high yield savings account or invest in Vanguard Real Estate ETF, symbol VNQ. Here's a quick tip: revisit and rebalance yearly to ensure your portfolio matches your lifestyle and income needs. A solid investment plan evolves with you. So let's wrap it all up with the key takeaways, the ultimate blueprint for a lifelong financial success. Number one, in your 20s, take bold risks with stocks and high growth opportunities. Number two, in your 30s, balance growth and risk with stocks, bonds, and small allocations and to crypto and gold. Number three, in your 50s and 60s, shift towards stability and income with bonds, dividend stocks, and real estate. Number four, in retirement, focus on income preservation and liquidity with bonds, cash, and income generating assets. Number five, diversify across assets. Stocks, bonds, crypto, gold, and real estate all play a role in growing and protecting your wealth. Number six, rebalance regularly. Life changes. Your portfolio should too. Adjust yearly. And number seven, use the right tools. Platforms like Coinbase, PHYS, PSLV, IBIT, and ETHE, the Ethereum ETF, make investing simple. Start now. The earlier you invest, the better your financial future becomes. Now that you know how to invest, it's time to take action. Start today. Don't wait for the perfect moment. Choose a strategy that fits your age and risk tolerance and rebalance yearly to stay on track. Do you want the full $50,000 portfolio breakdown? Subscribe and drop your email, and I'll send you a detailed allocation for your 30s and 60s straight to your inbox. If this helped, hit like, drop a comment, and let me know your biggest investment goal. We have new videos every week. Don't miss the next one. Let's build your financial future together. Also, please read the disclosure below. See you in the next video. Thank you.